Hey everyone, Marcus Millichap just released the 2026 Multifamily Investment Forecast. Now, even if you're not focused on apartment investments, I still recommend taking a look. Where people live and the markets where apartment demand is strongest can impact the performance of all other commercial property types. This extensive report includes several unique and insightful features focusing on things like the variance in operating costs across different regions of the United States, how demographic and economic trends are shaping housing demand, and how the multifamily development pipeline is pulling back. These trends will have ripple effects on every other commercial real estate property type. In addition, this report drills into the key multifamily investment trends for 50 major metros, providing detailed data and analytics. And it includes the annual Marcus Millichap Multifamily Index that ranks the markets based on their one-year investment horizon. Now, I'm going to highlight this year's top 10 multifamily investment markets for 2026. Coming in at number 10 is San Francisco. Yes, you heard me right, San Francisco. Now, the Bay Area as a whole has faced a lot of headwinds since the pandemic. But if you look at the impact of AI on this metro, you'll see some really interesting trends. There are still enormous barriers to homeownership in this market. Apartment vacancy rates have fallen significantly over the last year, and Bay Area rent growth is expected to be among the strongest in the country in 2026. Number 9 this year is Houston. Job creation in this market continues to plow forward, but construction pulled back earlier in Houston than other Sunbelt markets. As a result, the supply overhang is not as severe in Houston, and the variety of employers and economic drivers in this metro will sustain resiliency in 2026. Raleigh-Durham comes in at number 8. And again, the diversity of the employment base and the slowing construction pipeline are key ingredients supporting this market's multifamily outlook. Vacancy rates are forecast to trend lower in 2026, supporting modest rent gains. The number 7 market is Seattle. In 2026, we forecast vacancy will decline modestly in the Seattle metro, and that will support another year of rent growth. In 6th place, we have San Jose. As I highlighted in San Francisco, AI continues to drive the Bay Area, and although we anticipate a hiring slowdown in the Silicon Valley this year, there will be very little construction and the barriers to homeownership in the metro are significant. So we forecast tightening vacancies and the strongest rent growth of any major market in the US for 2026. At number 5, we go across the country to West Palm Beach, where we expect steady job creation, limited construction, and moderate but steady rent gains. Orange County, California comes in at number 4. Again, the combination of sturdy job creation, limited construction, and high barriers to homeownership will support the performance of multifamily assets in this region. The number 3 market this year is Miami, another Sunbelt market where construction is diminishing, hiring remains positive, and rent growth is expected to outpace the national average. At number 2 is Chicago, which had exceptional rent growth last year, very little development, and a lot of momentum coming into 2026. And the number 1 market in the US based on a one-year outlook is Fort Lauderdale, Florida. Like Miami, hiring remains positive and the construction pipeline is thinning. We forecast vacancy rates to tick lower in 2026 and rent growth will remain positive. So there you have it, the top 10 multifamily investment markets based on a one-year horizon. You can get a copy of this just released report on marcusmillichap.com and get our take on the national multifamily investment outlook. This in-depth research will help you keep your eyes on the horizon.